Absolutely anything can happen in the market. Today I'm going to talk about two companies that plan to merge into one by the end of the year, Shift Technologies and Carlos. Both stocks are extremely cheap, and the company that is going to be acquired has a negative enterprise value. The market capitalization is $47 million, which is less than the difference between the company's cash and debt. That is, in fact, the market gives away this business not just for free, but actually pays you for buying it. The only problem is that the business is unprofitable. Both companies buy and sell used cars. I have already made several videos about one of these companies, Shift Technologies. Shift buys and sells used cars directly to and from consumers through its e-commerce platform. Once Shift acquires a car, it inspects and repairs it through its regional reconditioning centers. Then the company lists cars on its website, where consumers can purchase the car online or book a test drive appointment in their local area. As it is said in the company's report on SEC.gov, Shift's mission is to make car purchase and ownership simple, to make buying or selling a used car fun, fair and accessible to everyone. Shift provides comprehensive technology-driven solutions throughout the car ownership lifecycle. Finding the right car, a seamless digitally driven purchase transaction including financing and vehicle protection products, an efficient fully digital trade-in sale transaction, and the vision to provide high-value support services during car ownership. Each of these steps is provided by Shift's software solutions, mobile transactions platform, and scalable logistics, combined with the company's centralized inspection, reconditioning, and storage centers called hubs. The report for the second quarter came out weak, with revenue less than expected and loss larger than expected. The company sold 6,872 e-commerce units, which is 17% higher than a year ago. Carlos had just over 2,400 vehicle sales in the second quarter. Shift's average selling prices per unit increased by 28.4% to $28,373. Average monthly unique visitors increased by 49.7% to 833,320. In 2021, the company showed crazy revenue growth as well as its competitors. One of the drivers of revenue growth was a 300% increase in prices for used cars. Last year, used car prices have grown a lot because rental car companies were facing a near halt in demand in 2020, selling off their fleets to raise enough cash to survive the pandemic. And after the rebound in travel, rental car companies faced a shortage of cars to rent and couldn't sell what they had even as demand for cars soared. Millions of people have gotten jobs again, and also millions of people who were working from home returned to the office, increasing the need for vehicles. So the prices of used cars have grown a lot in 2021, which is one of the main drivers of used car companies' revenue. Now the used car market has stabilized, and Shift's year-over-year growth have slowed down significantly and now stands at 44%. Well, the market is cyclical. If there is a shortage now, then there will be glut. The used car market has returned to normal, prices aren't rising anymore, and these companies have suffered from their pursuit of triple-digit growth. Now Shift Technologies, as well as its competitor Vroom, are slowing down the growth of their businesses and are focusing on improving margins and accumulating liquidity. Shift focuses on more profitable sales, so year-over-year growth will slow down even more. This is the right thing to do, but not timely. Well, it's better late than never. Shift Technologies plans to continue to optimize its inventory mix and assortment to favor value vehicles, which the company defines as vehicles older than 8 years or over 80,000 miles. These vehicles have higher profit margins. The company plans to reduce its operating hubs from 10 to 3, as it is said in the company's report on SEC.gov. On August 9, 2022, the company announced the implementation of Project Focus, a restructuring plan designed to position the company for long-term profitable growth by prioritizing unit economics, reducing our operating expenses, and maximizing liquidity. The primary elements of the plan are as follows: optimizing unit economics by streamlining all sales through Shift's most profitable online checkout channel, which allows consumers to purchase a vehicle entirely online, and eliminating test drives, rebalancing inventory mix and assortment, to favor value vehicles, consolidating Shift's physical operations to 3 West Coast hubs in Los Angeles, Oakland, and Portland to efficiently support our new delivery-centric fulfillment model, and closing 7 existing hubs. The indicator that I follow all the time is the operating expense ratio. It's declining over time, which is a good sign, but the company is still far away from being profitable. Shift's balance sheet looks very sad now. The company has negative shareholders' equity, i.e. total liabilities exceed total assets. Considering that the company loses money on every sale and burns cash, it's not surprising that the stock price is down so much. But Carlot's balance sheet isn't that bad. In total, the two companies have about $585 million worth of assets and $450 million liabilities. So the merged company can still live for some time. In the end of the day, the deal looks pretty interesting. There are quite a few benefits for Shift Technologies. Besides the fact that Carlot's has negative enterprise value, Shift Technologies will have one less competitor, the potential for significant synergies, and a better balance sheet. However, the risks are still extremely high. The company keeps burning cash and it is not going to become profitable soon. But the management seems to be adequate and is taking the right steps. That's all for today, and thank you for listening.